So we are expecting, other members to join in within next 5-10 minutes time. As we promised that we should be starting all these programs right on time, and because we felt that members, they are coming here not for attending the CPE but to learn something from the speakers. It's good to point out here. Can you believe it? The past president of Institute of Chartered Accountants of India, CA Subodh Agrawal, he is sitting at the front row to listen to the speakers and to know about this subject. This can be taken as an example. The person who was at the helm of the affairs, still he is having that aspiration to learn and to, to spread this knowledge to others as well, because you would be speaking on this Indies in next couple of days time. Big round of applause for our past president. The heartthrob for all the members of Eastern India, CA Subodh Agrawal. I would request the speakers for the day, CA Bina Iyengar and Dr. Amitabh Mukherjee, who is a father figure for the Eastern India, to please come forward and take their seat on the dais, and the Nitesh Moore, the coordinator for the program. A big round of applause for all of them. Let's start the formalities of the program with the motto of our institute.
Sukteshu Jagrati Yesha Sukteshu Jagrati Kamam 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 Pursho Nirvimana Nirvimana Tadeva Shukram Tadeva Shukram Brahma
Thank you very much. This is the second day of this Indies refresher course. What we have initially stated that we require feedback from all of you. And it would be taken in the right spirit, ladies and gentlemen. More and more those feedback would be required. Because we need to redesign the course. We need to streamline our infrastructure as well, because we got feedback from the last day that people were not attending. Those who would have served tea, water on time, they could not. That has been taken care of. The feedback from the people who were sitting at the end or sitting at the back, that the slides were not visible. Just to bear with us for a couple of days time, because we have to put one screen there, which is not possible at the time. For the time being, but these feedback, it would really help us to improve our infrastructure and improve our service quality to the members and students. So my humble submission to all of you that please come and share your feedback. एक तो छोटा problem हमें दादा एक तो माफ करे देवें, but at the same time we are putting emphasis on the course material and as well as the deliberations by the speaker, and I hope so that after completion of this entire course, your feedback would really help us to redesign or reframe the course for the betterment of the overall course material. So with this, thank you very much once again, and I would request Nitesh to start the other proceedings with the speakers. Thank you.
Thank you, Chairman. An email has been sent to you today that contains the day-wise Indies, which of the topic will be discussed. Although a revise will be again sent to you by tomorrow, but that email also contained the PPTs relating to the materials and the text of the Indies that has also been emailed. An additional email will be sent to you that will contain the bulletins that has been published by our central committee and other materials also. And course material we will be able to give at the end of the session. That we are very sorry for that. I would now introduce CA Veena Hingar. She is a professor and director in South Asia Management Technologies Foundation. She among the few Indian authors writing for international publisher Willis. She has authored book on IFRS and information system audit. She is traveling in many countries outside India, South Africa, Dubai, Mauritius, and Bangladesh, Sri Lanka, Thailand, so many countries also. She is a regular speaker. She is a chartered accountant, company secretary, CISA, and a master in science. I would request everybody to put your hands together for Veena. May I request our past president Subodhi to please come forward and offer a flower bouquet to.
No, he cannot.
Okay. Shivji, please.
He's my senior.
No, sorry.
Yeah, wait, no issues are passing regular.
Now, as Amitabh Mukherjee has already been introduced, I would straight away request Manish ji to please come forward and offer dry fruits bouquet on behalf of all of us to Amitabh Mukherjee, please. Now it's time to hear from the Veena ji.
Sorry, go down.
Well, good evening. It's nice to be back here. And as I was pleasantly surprised when Nitesh told me the Veena Hingar, I thought I was animate, not inanimate. So because it has more importance over here, since the fair value accounting or measurement for those two are separate. So if he calls me the Veena Hingar, no, the Veena Hingar, then my fair valuation would become different. Right. Now, when we are talking about this standard fair value measurement, I'm lucky that we are doing it at the beginning, almost at the beginning, because this standard will have implications across various standards that you will come across in the Ind AS. Now, when we are talking about fair value, just let's keep the session a little interactive, right? So what is your perception? What would be fair value? Realizable value, okay. So colloquially, when we are talking about fair value, if we look at the old definition of fair value, it would say that the amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's length transaction. If we look at the Excise Act, we look at other acts in India, most of the acts, when they refer to something as a fair value, they meant that it is basically the amount for which something can be exchanged or settled between the knowledgeable, willing parties, okay, in an arm's length transaction. So what has really, if we understand this crux of the matter, you understood the entire crux of the IFRS 13, sorry, I'll keep saying IFRS because for the last 10 years I've been practicing IFRS. So it's kind of ingrained in me. It's Ind AS 113. why did this definition need to be changed? Why did the IASB think about changing this definition was, it did not specify whether an entity is buying or selling the asset. When you talk about exchange of asset, I may be buying an asset or I may be selling an asset. So whenever companies earlier thought about fair valuation, I would think from my perspective how much I would get if I sell this asset. Okay? So it didn't really clarify whether it was a buying transaction or a selling transaction. When it talked about settlement, settlement could have various kinds of meanings. Okay? It could be, it does not only mean settling a creditor, right? It could be settling maybe a deal, settling a exchange, so it could be anything. It was not clear about what market, whose fair value do we need to take. We did not know that. Would I need to take a fair value in India? Would I take it in US? Would I take it in the UK? Where would I take this fair value? That was not very clear, and it did not also say what was the place in the time in which this fair valuation meets settlement. The settlement takes place for fair valuation. Keeping on all this in mind, yeah.
This definition does not say about the independence between the parties, independent parties.
Arm's length transaction.
Arm's length.
So the independents get covered there. So this was the old definition of fair valuation, which the IASB, when they deliberated upon it, they said that it needs change. And it was much later, after a lot of these standards had already been issued, that the fair value measurement standard came in. Because there was also places in other standards where fair value has been mentioned and the method of doing fair value has been mentioned over there. If that be the case, where there is a specific method in any other standard, that standard needs to be followed. Like in some places it will say fair value less cost to sell. Then you have to follow that method of fair value less cost to sell. So I will, but wherever there is a mention of fair value measurement, you go for this. Okay? You go for this standard. Now this standard, one of the major thing that it is telling us, that whenever you go for a financial reporting and you're trying to measure at fair value, you need to first collect a lot of data. You can't just take the figures and start doing a fair valuation, right? You need to collect data about the market. You need to collect data about the market participants. You need to collect data about the highest and best use, and so on, a lot of items. As we go through the presentation, we will discuss them in details and then look at the impact of each one of them in the Indian scenario. Okay. And most important is, we need to know that, have knowledge about valuation techniques. I have heard many people talking about that we can take a registered valuer. Well, a company cannot continue at a large expense being spent only on accounting. Most companies worldwide do this fair value accounting within the organization itself. They do not employ external registered valuers unless, you know, if there's a merger acquisition coming up or if there's an IPO coming up, it's only then. But for regular day-to-day activities, you need to know how to do it in-house. Now this standard explicitly scopes out certain items. It will not apply to share-based payment. It will not apply to leases. It will not apply to certain applications of inventories and impairment of assets where they are talking about a net realizable value and not about a fair value. Now let us look therefore, what is this? Yeah. This is the old definition. The previous one? Yeah. Should I read it out for you? Is it visible? Okay.
In case of real estate, if the battery be the property, in case of real estate,
In case of real estate, what is going to be done, right? Let us look at the procedure of fair value measurement, and I will then take up your question. Because let's first look at the procedure, what they have prescribed. Probably your answer will already be found in the procedure, and we'll still take up the discussion after we complete this deliberation, okay? Remind me, I'm pretty forgetful. So what is this new standard? What is the change from this old standard, and what is old meaning of fair value, and what is it telling us? It tells us the price that would be received to sell an asset. So when the company is selling an asset or transferring a liability in an orderly transaction between market participants at a measurement date. Now what is the implication of all this? The first thing, if I have an asset and I am trying to find out a value at which I can sell the asset, the challenge lies, say I have a machine which is 50 years old and I have used it, and then today I am thinking I'm going to sell the asset. What will be my value if I sell the asset? So the challenge was lying there, that normally who would give you this value? Okay, you don't have an interested buyer. So when this discussion came up, there came up an explicit description. If you look at the basis of conclusions and you look at the application guidance of this standard, they have now explicitly described how this valuation will need to be done. We will discuss that during our session. The other very important material which is downloadable from the internet, which is because IFRS and Ind AS there is almost no change between the international and our Indian one except for the terminology of financial statements being replaced by balance sheet, and one more place regarding the deferred tax, I think. So there is a educational guidance which has been issued by IASB. It is available for reading. If anyone wants to read further into fair value measurements, it's an excellent source. It has tons of examples, how you're going to deal with every case and how it's going to be done. Now, apart from asset, it's also telling us about a liability. A liability, the entire balance sheet therefore needs to be fair valued. Now when we are valuing a liability, we will keep in mind that we are looking at the organization as a going concern. Because valuing a liability as a going concern and valuing the liability as a not going concern will be very different. So this valuation in fair value measurement will always be done assuming it's a going concern and assuming that whoever will be taking over the liability from us will continue to settle that liability. Right? It's extinguished right there. In an orderly transaction between market participants at the measurement date. Now the measurement date is the date of your financial statements. Okay, it is not the date on which you are preparing or where the board is passing the financial statements. If it's 31st March, measurement date is 31st March. Now this measurement date has a lot of implications when you are practically implementing this. Because you have another standard of events happening after balance sheet date. If there are certain events which have or knowledge that you have gained after the balance sheet date which has implication on any of the valuation methodologies that we will discuss, that information cannot be considered. So if you're projecting a cash flow to find out the discounted cash flow value, suppose one of the methods, then in that case, if there is some information which is available on the cash flow pattern post the date of your reporting, that cannot be considered. Okay, because that has to be handled by a different standard. Now, by looking at this, the whole concept of valuation has changed from entry method to exit method. Am I making a right statement? I would say no. Why do you think I'm telling you no? Because if you look only at this standard per se, yes, it's a pure exit method. But when you look at all the IFRS standards together, I mean India standards together, I say it is not a pure exit method. Why do I say that? What is the difference between an entry price or an exit price? Entry price means at which I am buying some asset. Exit price means at which I can sell that asset, right? Now in the accounting stack all across the Indias, they have given you an option of cost and revaluation method. Most companies, manufacturing, trading companies, etc., they go for cost method. They don't go for evaluation method. If you don't go for evaluation method, you're not applying this at all. Okay? When do you go for the evaluation method? When do you think you should be going for the evaluation method?
Enhance the value of the balance sheet.
No? You're going to die in the next year with the depreciation charge. Unless your company is making a super profit of 50 to 60% contribution margin.
The expected market value of assets seems to be very
Just before you are selling a particular asset, that means you're saying. But in that case, in the fair value, when you apply the evaluation method, you have to apply it to the entire block of assets. So, either you are spending a lot of money following the revaluation method every year, once in 3 years, which most companies will not do, or you go by the cost method before you're coming for a merger, before you're coming for an IPO. It's only then that you go into the revaluation method. And you have a basis then, explanation and judgment by the management that why you're doing that. But for purpose of land, normally you go for evaluation method. Because land is a separate group of assets and has no depreciation effect on the balance sheet, on the profit and loss account. So land is a very good candidate to go for evaluation method. The others are really not. Right? Now in the Ind AS standard, in the Ind AS 101, they have mentioned that in your first time adoption, when you take the fair value of land, say, you can take the value by a registered, I think, valuer, that's the word they have used. That's something that the Ind AS has introduced, which was not there in the IFRS. Now, what happens post the first year of adoption? Every year you're not going to get it valued. You don't need to get it valued from the registered valuer. Then you come to the fair value measurement standard. Now, it is a current price. The challenge is how to make the price current. Most of the data that you will get will be past data. When you have got some past data and you will need to find out what could be the current price, you need to find out some statistical methods in which you can do a trend projection, in which you can do a yield curve projection, and you can use Poisson's theorem of uncertainty. You have to freeze on those methods that how are you going to bring the past price to the current price. So that is one area that all of you would need to work up, okay? Because this is not talking about a past price, it's a current price. It's a market-based view, not an entity's intention. What does that mean? I have this building, okay, on Russell Street. Name has changed now, but I always call it Russell Street. Okay, and it gives me an X amount of revenue. Today, if I shut this down and I start a hotel over here, how many of you think it will give you a higher revenue? Only one person. Many of you, right? If I open a hotel in this premises, prime location, compete probably with JW Marriott, right? And
Not possible.
why not possible?
Land is not available here.
No. If this building is converted by the institute, right? Maybe a extended arm of JW Marriott, and I'm going to earn a lot more money. Okay? Now what do you think is the fair value? Or maybe I tie up with some real estate person and pick up a building over here of 20 floors. Now what do you think is the fair value? Would I consider that value as the fair value?
Highest and best use whatever is possible of it. It is entity based.
Huh?
It is not in general fair value. It is entity.
But it is saying it's not the entity's intention. It clearly says that.
Similar market value.
Similar market value, if you take of this building, today the value of Russell Street is way higher.
Potentiality use.
Hmm?
Potentiality for using for the alternative purpose.
Okay.
That can be noted.
So they've said it should be financially, legally, physically and socially possible. Today if the building is to be converted to a hotel, I'm sure all of us members are socially not going to let it be converted. So there is a restriction over there. So when I am considering a market-based view, I have to also take the market assumptions made by the person who is creating this market-based view. Whoever will come here to buy, they definitely knows there is a whole host of chartered accountants behind. If you make them angry, all their companies are going to be doomed because next year we're going to audit them, right? So socially it is not going to be possible. So even where I'm taking a market-based view, I need to look at the possibility of it happening, keeping into consideration the economic, the financial, the physical and the social possibilities of it happening. That is why you will see schools in very rich areas, they still do not close down. They still run, even if it's running at a loss. And under the Ind AS, you still value them as a school and not as a property. Right? And of course, the value cannot be a liquidation sale or a forced sale.
Why not politically also? It has to be politically feasible in Bengal at least.
Politically feasibly, that is means economically feasibly, all these feasibilities will need to be seen. Point noted, very good point.
Time value of money.
Yeah.
Present value at discount.
Yes. Now, when we are starting our project on fair value measurement, the first thing we need to talk about is the asset or the liability, what is the unit of it, we'll go into description. Then we need to decide upon what is the highest and best use, we'll come to that also. What is the valuation premises? Keeping in mind that I need to take an exit transaction in the principal and most advantageous market. It's a market participant assumption, and so we're going to look at who are these market participants, and then you have a number of valuation techniques that you have to apply, and then the management takes the decision of which is the best value or the fair value of the asset, and then you have a host of presentations and disclosures that are to be made. So this slide is your entire standard in a crux. Looks very colorful, not colored by me, colored by IASB. This is an IASB slide, so I should acknowledge that. Much of the resources, some of the resources which have been used here are IASB resources. So I should acknowledge there, because I was sharing a stage at the World Accounting Forum where a IASB gentleman made this presentation. So I took it from him, but it's not my slide.
Actually, it's a very colorful process, and that's why they have used colors. Well, fair valuation is a very colorful process.
Okay. I thought there's only one color in that. Everything needs to be black and white, no other colors.
More black, less white.
Now picking up the first discussion on the asset or liability. Now when we are talking about an asset, I need to take into considerations the characteristics that market buyer would take into, or market participant would take into consideration regarding that asset. So condition, location of the asset, whether there are any restrictions on the asset, I have to consider those. So suppose I have an asset in Zimbabwe and anything that is earned from the asset I cannot repatriate into India. It's an Indian company with operations in Zimbabwe. The government is now not allowing any repatriation to India. What will be the fair value of that asset? Zero is too simple. I wouldn't have asked the question if it was zero.
It will be the local value.
And Zimbabwe is a high inflation economy, super inflation economy, so you have to consider that also.
See, it would have been,
valuable, then you won't get anything in India.
yeah, you won't get anything in India.
So
So
what
that
do
is,
they use the 17, 18 years of cases happen? I've seen in the bank.
yeah, exactly.
The money never comes.
Yeah, but I still hold an asset there in Zimbabwe. Probably get in the future. I will shift to Zimbabwe and make my house there, and it's valuable to me.
So the Zimbabwe price
Economic benefit that is available in that country.
in the that's a
So where it is not possible to go by cash flow method, then I will need to take the market participants market valuation method, where I am going to go by a method of measuring through market multiples. We'll come into details over there. So even where apparently it will seem that there can be no cash flow from this particular asset, then also I need to look at other methods of valuation. Okay, so we'll come to those methods. And then what we do, because of this sovereign risk, we have to create a discounting factor for the risk to bring it to a value for us. So wherever there is a risk factor involved, I need to identify all those risks, because adjustments will we need to make for all those risks when I come to the fair value. Right? So that is the reason. Restrictions, if any, on the sale or use of the assets come into being. So suppose I have credit risk, market risk, sovereign risk, counterparty risk, host of risks that we have to consider when we are coming to the restrictions. And very, very important in banking, financial institutions, companies with international business, you really need to chart down the risk. Like in a banking sector, you have almost 22 different kinds of risks which affect the fair value. So that is something that you will need to look at.
Can I ask you a question? Group of assets, the risks are diversified.
Yes.
Different assumptions will be done within the same group of assets, or a single assumption?
No, one group of assets, one way of counting. See, the policy has to be set for the entire group of assets. Now, in the policy, Now, did you consciously build up assets which were moving in two different directions? Then I will look at Ind AS 109. Okay? I have to test whether they are embedded derivatives. I have to test whether it is a hedging transaction. There are certain norms of hedging transactions. If it is not, then it's just two assets which are moving in different directions. So automatically, when you are looking at the total value of a group, I will, in that case, I'll take a decision. I won't do an asset-based fair valuation, I'll do a group-based, unit-based fair valuation. So automatically that effect will get cancelled out.
So asset-based is also allowed.
We are coming to that. Asset-based is allowed, but sometimes you don't want to do asset-based ones, so you can always have reasons for which you do a unit-based or a group-based one.
It will be much more cumbersome. Asset-based will be much more cumbersome. Because for each asset you have to identify the
Yeah.
derivatives.
So you will not, you will make a judgment that it is not possible to identify the cash flows from individual assets, and therefore it needs to be done on a group or unit basis.
Right.
But sometimes it depends on the situation what you want to do. Now in the assets, I'm sure none of you can read this slide. Right, there's plant, property and equipment, intangibles, investment property, financial instruments, biological assets, defined benefits and inventory, which explicitly talk about fair value measurements in the standards. And each of them, if you will look, they are talking about choices between cost and fair value, cost and realizable value, and etc. etc. So the first thing when we are trying to do the shift towards the Ind AS is to identify the various options available under each of the standards before coming to this 113 standard. Okay? If you feel that the option is better for any other standard, say financial instruments, you have no option. Okay? But say plant, property and equipment, if you think your other options are better and easier to implement, I would advise don't come to the fair value measurement standards at all. Because this one is very, you need to do a lot of working, and unless you're a very large company, it's difficult to get the resources. Again, I'll acknowledge this slide is of the IASB slide.
In that case, the AS16 will be, Ind AS 16 will be applicable.
Ind AS 16 is giving us an option of cost or evaluation method. Only if I'm going for evaluation method, then only I need to do this fair value less cost to sell. That is the reason. If I'm going to cost method, all this problem is not there at all. We were talking about it can be done on a single basis or it can be done on a group basis. Now I need to just point one more thing out here is when it comes to intangible assets. Intangible assets will always be done on a single basis. Intangible assets, even though belonging to a group, you will need to find out its value separately, fair value separately, because the intangible assets which have an active market or which do not have an active market, two kinds. When you do the intangible asset standard, I'm sure it will be covered by during these sessions, then you will see over there that every intangible asset will need to be valued or tested for impairment. So they will automatically need to be fair valued. Now when we are talking about the market, which market? They will, if I am, say, have a machine, okay, say I have a rolling mill and I'm going to sell it, it's too big a machine to sell internationally, let me see. Say I have a tractor and it can be sold to the US, it can be sold in the UK, it can be sold in the Middle East, it can be sold in India, it can be sold anywhere in the world. So when I am talking about the market in which I have to find the fair value, which market would I look at? So it says, you look at the market, you don't need to look at the whole world. Look at the market you have access to and the market in which you usually do your business. So even in India, if I am doing my business here in West Bengal and I am not spread out all over India, West Bengal is my market. My buyers and sellers all in West Bengal. Okay? So the market doesn't mean it's going to be like worldwide market, anywhere in the world I'll go and find any price. Okay? So, sorry, my typo is again coming IFRS, it should be in DS. I am consistent about the market in which the market participant would transact. Why do I write this word? They are inconsistent about. It is up to you to decide which is your principal market, which is your most advantageous market. And then you will base all your fair value measurements based on that particular market that you have chosen. The exit transaction may take place in a principal market or in a most advantageous market. What is a principal market? Where your highest volume of sales takes place or your highest activities takes place. Most advantageous market, which is the most beneficial market for you, okay, which will minimize, the amount of transfer of a liability or maximize the amount of an asset. Now when we are finding this out, this market, when we are talking about principal market or the most advantageous market, every transaction will have many costs associated with it. Right? When I go into an agreement with contract with somebody to buy or sell, there's a contract cost there. Then there's some transportation cost there. There may be some other costs involved over there. So the standard says, when I am trying to find out which is the principal market or the fair value at the principal market, I will only consider transportation cost. But if, this is a very big anomaly in the standard, if I am considering the most advantageous market, I am looking at all the costs. What is the net benefit to me? That's the most advantageous, right? So, if you define something as a principal, say I have 100 as my selling price and I have 20 as my transaction cost and 10 as my transportation cost. If I am going by principal market approach, what will be the fair value?
90.
And if I am going by advantageous market approach, 70. Right? Say I have selling price of 100, my transaction cost is 20 and transportation cost is 10. In principal market fair value calculation methods, you can only take transportation cost. But when you are talking about most advantages, why do they take only transportation cost? If you read the basis of conclusion, they say that unless it is transported, it cannot reach the person. Although I don't agree with the logic too much, but that's what the standard is said. So if you go by principal method, market method or advantageous market method, you will arrive at different values of fair value. So whatever method you take, you make the disclosure in the notes of accounts. This method has been chosen and this is the reason why I have chosen the method. Automatically your entire cash flows change. Your entire value of the asset changes. Okay?
It applies to immovable assets also, what you are saying.
Transportation cost will not be there. So there, the transaction cost is there. So it will apply there. Now, to sell an asset or transfer a liability at measurement date under current market conditions in the principal market or in the most advantageous market. Now the principal market, when you're deciding on this principal market, you have to find out what is the greatest volume or level of activity. Okay. Now why are these two words used? Volume as well as level of activity. I may have the greatest volume, I may not have this greatest level of activity in a particular region. It can happen. In that particular region, the number of items sold are very high, volume is very high, ticket size of the items are smaller. So in that case, the volume will become very high, level of activity may be very low. So that is the reason that what they have written over there is very critical. It says the principal market is market with the greatest volume and, it's not or, and level of activity for the asset or liability. If both these are not fulfilled, you can't go by principal method, you have to go to advantageous method. Okay. We face this in one of the engineering companies over there in the Middle East, where the volume and the level of activities and clause played a critical role. That's why I wanted to discuss it. Probably the example wouldn't be there in any other books because it's a practical thing we faced. So that is something that we need to look at. Now, it takes into account all information that is readily available. For this, you have to look at Ind AS 1, which talks about the time and cost benefit. Okay, that you don't need to always be 100% correct. All these are estimations. So you spend only that much of time and cost that there is no material misstatement to the readers of the financial statements. So if I am making an estimation and it does not have an implication on the decision process of the readers of the financial statements, I may not be 100% correct, but yet I can go ahead with it. Market in which the entity normally transacts is presumed to be the principal or the advantageous market in absence of a principal market. We just discussed that. Now the most advantageous market is the market which maximizes the amount that will be received on sale. We just did that after taking into account the transaction and cost and transportation cost. Now what happens is, when we are finding out these eligible markets, a company will normally have multiple products. Each product wise, you will have to assess which would be your market. Right? So you need to normally create this chart on Excel where you have all the product lines and you make analysis of the last 5 years, that where the highest sales volumes have taken place and where the highest level of activities have taken place, because those documentation you have to keep when you're first time accounting, right?